Hi there, Evan here at the Chronicle, where the future starts today. For Wednesday, August 21st, 2019, the Canadian CPI report for July came out this morning, and as usual, it's hotter than expected, and the biggest contributing factor, as I've been saying on here the past couple of months, this is from Capital Economics, vegetable pricing year over year, we are up 16%. Grocery store inflation from a weakening Canadian dollar was a thing, is still a thing, and will be over at least the medium term here. Nothing has changed on that. And the next chart I'm going to overlay here is the annual change in mortgage rates versus the mortgage rate inflation metric used in the CPI. And as you can see here, we all know rates have come down in recent times following declining bond yields globally, on expectations of a slowing global economy, inaction from central banks cutting rates to try and re-stimulate it. And the annual change leads the metric on the CPI by about 4 months, which would then bring the CPI back down to the 1.7, which ironically enough, from this tweet out here by Hedge, that's what they expected for this month to begin with. So what do I think happens now at the Bank of Canada? Does this change where they're going to go going forward? Personally, I don't think so. They're going to look at the data here. They're going to see it as transitory because it will work its way down. Whether you like it or not, this is how they view it. And my prediction from before hasn't changed. The Fed is going to cut, in my opinion, an additional 25 basis points. That could change, but as of right now, Fed goes 25 in December, Bank of Canada will cut the next month, and then they'll follow the US going down. In fact, the last thing I'll do here is I'll overlay two charts here. The first one is the market global PMI index, and as you can see for last month, Canada and the US are the only ones growing. But another chart here put out by Capital Economics, non-energy exports really just follow what's going on globally. And as I said in the past here, a weakening Canadian dollar is not going to drive exports. The global economy is slowing down, which is going to hurt demand for manufactured goods. And I even mentioned it in a previous video a couple of weeks ago. Manufacturing is downstream from the consumer. If the manufacturing sector sees there's not going to be as many buyers going forward, they plain and simply are not going to make as many goods. They're not going to produce as much output. So as you can see here, our non-energy exports really just follows what's occurring in the global economy. And that's, I think, what's going to happen going forward here. And our manufacturing PMIs are going to contract like many other countries already have. So the moral of the story to summarize, yes, grocery store inflation is a thing and will be a thing going forward. Yes, CPI will work its way down because of mortgage rates. Hence, no, it doesn't change what I think the Bank of Canada is going to do going forward. That's all I really got to say. Smash that like button, leave a comment, subscribe, follow both my Twitter accounts, and as always, my name is Evan. This is the Chronicle, where the future starts today.